That's a good topic to talk about too, is, Mark, there are different types of buyers who have different types of jobs and things like that. And I think
Yes.
a lot of people, particularly those who may not, I mean, there's typical W-2 wage earners, like the teacher
Yes.
who's worked in a school district for 7 years. They know what their income is. But then you
Yes.
have people who are 1099 salespeople, or people who
Yes.
work on, large bonus bases. And
Yes.
they tend to, I don't think that they necessarily try to overinflate their income, but I think they have a misunderstanding of how their income is represented. And
Correct.
so, could you talk about maybe some of the differences that people may want to look out for if they're W-2 versus a 1099 versus maybe they have a small salary and a big bonus structure, on how
Yes.
they can help prepare themselves to bring the right documents or the right knowledge to their lender to help them get pre-approved?
So if you're self-employed, which may mean 1099 with a Schedule C on your tax return to report your income, or you own an LLC, or you own a sub-S corporation where you file on an 1120S return, those are all considered self-employed. If you work for a company that you own 25% or more of, you are considered self-employed. No loan officer can pre-approve anybody without looking at tax, or even pre-qualify anybody without looking at tax returns. So I have a small sole proprietor of a small company, and I say, well, guesstimate your income, and they'll say to me, oh, $250,000 a year. That's their gross revenues. By the time I look at their Schedule C, a lot of times it's $40,000 or $50,000, and that's a lot different. Plus, we average 2 years of income, and P&Ls don't count. A loan will not be underwritten based on a P&L. It's going to be 2 years of tax returns. We average those. And if the most recent year is significantly less than the year before, for instance, we have 2017 and 2016 tax returns, and 2017 is significantly less than 2016, we're only using 2017 income. So if it's a time of year like this, where we're in the beginning of 2019 and 2018 was a good year, you want to get those tax returns done, okay, so that you can use them to help qualify you. And I have a borrower doing that right now. With bonus, we count the base income as it is, and then we average 2 years of bonus. Once again, if the most recent year's bonus is significantly lower than the year before, we're only using the most recent year's bonus. A borrower should have a breakout of what their base is and what their bonus has been over the last 2 years. Okay, so we only care about the current base, but we care about 2 years of bonus. The other thing is with bonus is that their employer will have to state the likelihood of bonus going forward. And they don't have to promise a bonus, but they have to say that the borrower is likely to continue to receive bonus moving forward.
So there's a lot
And
more
that's
moving parts.
That is correct. Overtime is another issue. Overtime is averaged over 2 years as well. And if it's significantly lower in the most recent year, once again, we're going to count less of it. But so plus, with 2018, we'd have W-2s. That's all we need for overtime, and a written verification of employment from the employer breaking out the overtime and the base income. However, we're in a month into 2019 or a month and a half. We would have to see some overtime in the most recent pay stubs to continue to count the overtime.
Yeah, to make
Unless
sure
it's
that
seasonal.
continues.
Pardon me?
To make sure that continues.
Right. If it's seasonal, like for instance, they're a pool manufacturer, and most of their hours occur, say, from April through August, because that's when the biggest part of their busy season is, then a letter from the employer stating that most overtime is earned between April and August will go a long way to helping them qualify with that income. So you can see there's a lot of moving parts.
Yeah.